Hello, and welcome to SRA Accounts Rules Compliance. This is part one of a series of webinars produced by Hazlewoods. I'm Jenny Staight, a Senior Manager in our legal team, and I'm joined by my colleague Faye Warren, who's also a manager in the same team. Our contact details are on the screen if you have any questions on this webinar or its contents. Today, we're going to run through the background to the rules, the basics, and then we'll run through the SRA guidelines on accounting policies and procedures. The SRA Accounts Rules were first issued in 1998. The most recent version was issued in 2011, and we are now on version 19 of this. So why do we have the rules? Solicitors hold large quantities of client money. The rules are designed to safeguard client money, to make sure it's kept safely and only used for the purposes it was intended for. The principles are to protect client money and assets, ensure you act with integrity, behave in a way that maintains the trust the public places in you and in the provision of legal services, comply with your legal and regulatory obligations and deal with your regulators and ombudsman in an open, timely and cooperative manner, run your business or carry out your role in the business effectively and in accordance with proper governance and sound financial and risk management. So, who do the rules apply to? They apply to all practices that hold client money of any amount at any time. There is no exemption. The practice as a whole and all those who work within the practice, for example, cleaners, receptionists, partners. So if we start with the basics, the client, as defined by Rule 2, is the person for who you act, and client money is defined by Rule 12.2 as any money held or received for a client or as a trustee, and all money which is not office money or out-of-scope money. Money for payment of unpaid professional disbursements, which includes surveyors, estate agents, and translators' fees. Money held for payment of stamp duty, land tax, land registry fees, telegraphic transfer fees, and court fees. Payment on account of your costs generally, any financial benefit paid in respect to a client, and money held jointly with a third party. Office money is defined by Rule 12.7. Office money is money which belongs to the firm or is held in connection with running the firm. Interest received on general client account balances. Payments received in respect of fees due to the firm against a bill or an agreed fee. Funds earmarked for costs held on client accounts. Disbursements, including those paid by the firm and any which had been incurred but not yet paid. However, this excludes unpaid disbursements. And money received from the legal aid agency as a regular contract payment. So if we start running through the guidelines, the SRA guidelines are held as an appendix to the rulebook. If you depart from the guidelines in any way, you may need to justify such departure to the SRA, and if we as reporting accountants identify any substantial departures, we would need to report those departures to the SRA. Setting the scene, Guideline 1 is just an introduction which covers the best practice controls to help prevent breaches from occurring, identify and correct any breaches which have occurred, and to safeguard client money. Guideline 2 states that you must hold a copy of the rules or be able to access them online. The person maintaining accounts should have a full knowledge of the rules and the firm's requirements, and the responsibility for compliance extends to the coffer. Whilst the accounts rules do cover the protection of client money, they also cover all office transactions which relate to client-related matters. You must ensure that all entries are made in chronological order, i.e. that transactions are posted as they happen, and all of your entries must be kept up to date. 29.4 covers those office transactions, and 29.9 covers clients. Firms must also have a written interest policy in place. Interest policies should be fair and reasonable and should include a de minimis limit. This is how much a client balance must accrue before interest is paid. There's no set amount for this in the rules. Whilst a lot of firms have maintained £20, we have seen other firms increase it to as much as £50. Should you need a template interest policy, you can find one on our website.
Guideline 2 also covers office credit balances, which is essentially where client money is being held in the office account. Whilst this can happen where a payment of client money is made directly into the office account, this can also occur when credit notes are raised or if office checks are cancelled. 20.1 is client money transferred in error, so money transferred from the client to the office account, which is not properly due. 19.1b is where legal aid money is held in the office account for over 14 days. And 17.2 is where funds are transferred from the client to the office account before a bill has been issued. Our suggested controls for credit balances are that you review the client matter listing regularly. Most systems do have a standard report for identifying office credit balances, and it'd be good practice to run this every day, but as a minimum, you should do this on a weekly basis.
Guideline 3 covers the receipt of client money. When money is received, it should be identified as client, office, or out-of-scope money. Out-of-scope money is money for activities which are not regulated by the SRA. Care should be taken to make sure that receipts are posted to correct client ledgers to make sure that they show a current balance at all times. In addition, you must make sure that when money is received, it is promptly banked, either on the day of receipt or the next day following receipt. And you should also make sure that any money that should not be held in client accounts, so where it's earmarked for costs, is transferred to the office account within 14 days. Suggested controls. For prompt banking, we would suggest that you maintain a cash diary and reconcile this to the daily banking. This will help to identify any amounts received which haven't been banked and vice versa. For the 14-day rule, so funds earmarked for costs, we would recommend that you run a listing of all balances on office and client account and compare where funds can potentially be transferred. This list should be circulated to fee earners so they can review it and approve any potential transfers. Finally, you should also review client ledgers regularly because this will help pick up any issues such as the misallocation of receipts.
Guideline 4 covers payments from client accounts, and first of all, the authorisation of those payments. So all payments or withdrawals from the client account must be properly authorised. This includes client-to-office transfers, client cheques, and all other withdrawals. Those withdrawals must be authorised by a suitable person. That person does not necessarily need to be an owner or a manager of the business, although the responsibility for those payments will ultimately rely on them. That suitable person must have an understanding of the rules, especially how and when withdrawals can be made. And finally, the firm must have clear systems and procedures for withdrawing funds from the client account and ensure that all documents are retained. Our suggested controls are that transfer slips are signed to prove authorisation, that passwords are used and regularly changed for online banking, and that unused client cheques are kept safely.
Guideline 4 also covers overdrawn client ledgers. You must ensure that no client debit balances occur. Should they occur, they must be corrected on the same or next working day. If they are not corrected within this time, then they are reportable to the SRA, and you should also make sure that the funds are replaced from the office account. A suggested control would be to run a report on a daily basis to check for client debit balances. Your system should have a standard report. If it does not, then run the client matter list and check through this. This should allow you to pick them up as they occur and correct them promptly. Transfers of money for costs from the client to the office account are also covered in this guideline. It's important that a bill or other written notification of costs is sent to the client before any funds are moved. Once a bill or written notification has been sent to the client, you have 14 days to transfer the money from the client to the office account. Our suggested controls, as we've mentioned before, most systems do have a report that you can run showing outstanding amounts on client and office so that you can identify funds available and transfer those within the 14-day deadline.
It's important to make sure that you review client ledgers before making transfers to make sure that any funds are not earmarked for alternative purposes.
This guideline also covers client-to-client transfers. You must ensure that these are properly required and accurately recorded. Should there be any private loans between clients, you must obtain a written agreement from both parties before any funds are transferred. A suggested control for client-to-client transfers would be to maintain a file of properly authorised client-to-client transfer slips and attach any appropriate evidence.
Finally, Guideline 4 also covers residual balances, which is one of the main reportable breaches that we now see. To avoid residual balances from occurring in the first place, it's important to ensure that files are closed in a timely manner and that any surplus funds are returned to the clients. If there's any reason for retaining funds for a client, you must inform the client at least every 12 months in writing of how much and why those funds are being retained. A suggested control is that you review master balances for last movement to identify old balances, and that this list is circulated to fee earners regularly to ensure that they return those funds or donate them to charity as necessary. If funds are retained, you should keep a central register of all retentions and review this as part of your month-end process to make sure that clients are written to at least once every 12 months.
Guideline 5, the final guideline, covers the overall control of client accounts. So we must keep a central register, which should include all general client accounts, any separate designated client accounts and office accounts, but we also need the register to include any other accounts held by the firm. So any held for client money which are not client accounts, any held as liquidator, trustee in bankruptcy, court of protection or trustee of a pension scheme, any accounts held jointly with a client or another firm, and where you operate a client's own account as signatory. A suggested control here is for you to maintain a spreadsheet which includes all of these accounts and includes the dates that the accounts were opened and closed.
Guideline 5 also covers formal bank reconciliations for general and separate client-designated deposit accounts. When performing the bank reconciliations, you must perform a three-way check. So the bank statement balance and unpresented items must be agreed to the list of client balances on the system as well as your trial balance. You must review this list of client balances for any client debit balances that are overdrawn client ledgers. These must be fully investigated and rectified. Any other corrections noted on the bank reconciliations must be made as part of this process. Bank reconciliations must be reviewed by the COFA, although they are able to delegate this duty to somebody else who's an appropriate individual. And bank reconciliations formally must be performed at least once every 5 weeks before the next reconciliation date falls due. Most people will do this at the month end. Our suggested controls are that the reviewer signs and dates formal reconciliations as evidence of their review, and that they add comments as required as evidence that action has been taken to correct any differences or issues which were noted.
This guideline also covers the need for clear policies and controls over computer access. You should limit right to access to suitable persons only and give others read-only access. Access should not be restricted to one person, nor should it be open to more people than is necessary, and confidential passwords should be set but changed regularly. Suggested controls would include limiting right to access to accounts department and for IT to set up a prompt to change passwords regularly.
And finally, Guideline 5 also covers policies for retaining accounting records. So you must ensure that you retain for 6 years books of account, reconciliations, bills, bank statements, and passbooks. For 2 years, you have to keep all written approval of withdrawals. This covers transfer slips and any other internal documents or vouchers, but also covers copies of paid client checks. Your bank will often do this for you, but you need to check. This is covered by Rules 29.17 and 29.18.
Thank you for listening. As mentioned at the beginning, this is the first in a series of webinars, so please look out for our future editions. Our contact details are on the screen, so please do get in touch if you have any questions.